The question that I have is really relating to a family member. My brother purchased a house about a year ago, and I'm just looking for some insight if somebody can help me because you said no dumb questions. But when he purchased it, it's an FHA home,
Hmm.
and we thought that his mortgage would be set, that it doesn't change year to year or whatever. Okay. He received a letter about a week ago, but he just let me look over it yesterday.
Hmm.
And then it said that due to his escrow not being enough, that his new mortgage payment would now be $200 more than what it was.
Yeah.
Okay, but then they're saying like he could pay the unexpected escrow for the year that has just passed,
Hmm.
and then he would be still charged a new set monthly payment
Hmm.
for his new mortgage. So, I mean, how is that possible, or is that
Okay.
possible?
Yes, it is possible. So, do you have something to take some notes down with?
Yeah.
Okay, great. So, here's what's going on with that mortgage. He has his taxes and insurance in with the mortgage payment.
Right.
Okay.
Mhm.
Now, that's what changed. His mortgage didn't change.
Okay.
Something changed with his taxes and insurance,
Okay.
therefore, creating a shortfall in the account where the bank is paying the taxes and insurance. So there's not enough money in that account to cover that. Now
Okay.
there's a couple of ways to handle that. But go ahead. Did you have another
Okay.
question? Go ahead.
Well, I'm going to let you go ahead with the answer. And then it was turning into a two-part question, but you may have the answer in your response. So please go ahead.
Okay, so now you can raise your payment to cover the shortfall. They may also give you the option to say, okay, your shortfall is going to be X amount of dollars. Just pay that instead, one lump sum, and you can keep your payment the same. That's a
True.
couple of ways to do it. Now, the other thing to do is find out if you can opt out of escrow altogether and pay your own taxes and insurance. In some mortgages, you don't have to do it that way.
Okay.
Here's what you're doing when you're escrowing. The bank or mortgage company is creating a savings account for you. Okay.
Okay.
And in that savings account, then every time you make your mortgage payment, they're putting in that savings account. Now, when you hear savings account, you may think, oh, they're putting it in an account and I'm getting interest. No, when they do that, they're setting up a savings account and you will receive interest on that money you're putting in that savings account. And so once a year, they'll pay your insurance premium for your house. And then they'll also pay your taxes out of that account. So what you're simply doing is putting your money into a savings account. And it's like they're doing you a favor. But couldn't
I
you?
got you pay your land taxes and your insurance.
Right. Could you put it in your own savings account yourself?
I see what you're saying. It's better that way. But the thing is, when he purchased the house,
Mhm.
why was it not, figured to the point to where it would be, and I'm just asking,
Right.
enough to cover it?
Well, here's what happens. So when they first put
I
it
am.
together, they say, oh, your taxes are this much per year. But what if your taxes increase? Now you have to cut that. What if your insurance premium increases? Now you have to
Okay.
cover that. Does that make sense?
Yes. Here's the two-part question.
Okay.
Okay. When he purchased the house,
Yes.
it was under one finance company,
Hmm.
but then another finance company bought it out. So
Right.
could it be based on the taxes and the insurance of that state?
No, not at all.
Okay, just asking.
Nope,
Okay.
not at all. What is happening is something has happened with the taxes in his county or his insurance or both.
Wow. Okay, this is it. I promise. I hope.
No, 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 no.
Good.
Listen, this is good. Do you realize that so many people don't understand this and you're doing everybody a favor?
Okay.
Come on.
Well, thank you. But I'm glad that everybody else could probably learn something from it. But I'm really trying to help him out because, it's sort of discouraging when you first time home buyer and then you buy a house and you think that you're, on a good road and then that you get slapped in the face with something like this.
Hmm.
And it's like now your mortgage right at $600 is now going up to almost 80. I didn't bargain for this.
Right.
But anyway, so here is the third part question. Could he ask his bank that he banked with and that he's banked with for a long time to buy his loan from the company that has it now?
No,
No.
no. So because see, what's going on is you're talking about what's called
Getting somebody else to refinance.
refinance now.
Mm-hmm.
And it doesn't matter who holds your loan. Your brother signed a contract that he was going to pay a certain interest rate for this mortgage and keep it for X amount of years. That does not change no matter who owns the mortgage.
Okay, can you say that again?
Okay, one more time. Whoever owns the mortgage, the original contract with your brother doesn't change.
Mm-hmm.
So he's paying the same number of years. So if you take a look at the principal and interest, that's the mortgage part. The taxes and insurance is not mortgage.
Okay.
He has it in with the mortgage payment, but it's not the mortgage payment. The actual principal and interest never changes. That amount is fixed.
Okay.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.